So, if you're looking to buy a BMW convertible like the one in the picture right now, what would be the best time to buy this? Would you say the best time would be in the summer when everybody else is trying to buy a convertible? Or would the best time to be in the winter when nobody wants a convertible because it's raining and snowing and it's a bad idea to drive a convertible? Well, you know the answer. You want to go to the dealership in the middle of the winter and try to get a better deal. That only makes sense. Now, the same thing happens with stock. If you're looking to buy a company to invest in, and don't forget, you're investing in a company, in a business. You're not buying a piece of paper, speculative nonsense, meme stock. You're buying a piece of the pie, a piece of the business. If you're looking to buy a piece of the business, you want to buy when everybody else does not want to buy that. You never want to buy into the hype, into the FOMO. Everybody right now is going after NVIDIA, AI stock. They made them absolutely insanely expensive. Now, if you go and you try to chase these companies, you're going to get smashed. But like Warren Buffett said, when everybody is greedy, I'm fearful. When everybody's fearful, I'm greedy. How does it work in the context of stocks? Well, very, very simple. There's two types of stocks in this world. One type is growth. One type is dividend. Now, I know there's 100,000 different categories. I'm just simplifying it for the sake of this video. So let's assume there's two types. Growth stocks are now hot again after being hated on for a whole year and a half. But before that, growth stocks were absolutely hated on. Everybody wanted dividend stocks and value stocks when the market was down. The market is cyclical. Sometimes stocks are being hyped and sometimes they're being hated. The best time to buy dividend stocks is now, when the entire market is dumping them in favor of growth. And the same time applies for growth. The best time to get growth stocks was back in the day when it was the hated thing in the planet to buy growth. That's how it works. That's why long-term dollar cost averaging into good companies pays off in times like these. Now, I'm going to talk about that system in a second, but in today's video, I've wasted 2 minutes of your time. I don't want to do it anymore. I want to show you a company that I found, which I think would be a great addition to any portfolio given its current price and its current parameters. I'm going to pull it up on the screen so everybody can see it together with me. Now, I'm going to be using Stock MVP, which is my own platform, which I've created. More on that later, but if you want to check it out, it's actually in my profile below my face. Stock-mvp.com. Use the code LAST50 to get 50% off. I'm going to talk about the platform after I'm done with the analysis. So if you're just here for the analysis, I don't want to waste your time pushing you the platform, okay? So this company is called Bungie Limited. Now, I'm going to make the screen a little bit bigger so you can see the parameters here. So this stock has taken the beating. Over the past year, it's been down 9.3%. So while the entire market has been going apeshit crazy, this stock lost 10% of its value. Now, that already shows me that this is the convertible in the winter. Now, do you need a convertible? Do you need this convertible? Is this a good car? Etc., etc. All these questions we're going to answer right now. But the first question we already answered, which is this company is beaten down. It's hated. Everybody's dumping it in favor of NVIDIA and the hype stocks. And now is the right time to look at it. Now, switching to classic view here, from advanced view, let's go back and let's look at what this company actually does. If you unpop this menu right here, you're going to see the company's description. 23,000 employees. It's in Missouri. And what it does essentially, it operates an agribusiness and food company. Now, what does it mean? Agribusiness and food company? Let me explain like in plain English because this thing is like for geeks. What they do is essentially they make soybeans, wheat, corn, sugar. Mainly they process it, they produce it, they distribute it. It's a food business, but it's a base food business. I mean, nobody's eating soybeans or corn or wheat or sugar. These are base products which are used to make food. And this is what I love about this company. I love these base products because they make a lot of sense, especially in this market. And I'll explain in a second why. What I feel is that base food is anti-recessionary. And when things go south, and eventually they will, companies like this with base food exposure, they'll do better than the growth stocks and the hype stocks and the tech stocks. You want to buy them when they are hated the most, like they are right now. Now, you need to understand, and I will show you this in a second, that this is, again, this is a dividend company. As you can see right here on the screen, the dividend yield is 2.6%. It's nothing to write home about. It's not an insane dividend like 7 or 8%, but it's very, very steady. This company has never, ever cut its dividend. The dividend of this company, of Bungie, always went up every single year. They've never reduced the dividend in their history. So it's not exciting, but it always will keep going up, at least historically speaking, unless they change. But I do want to draw your attention to this thing right here. It's a low margin business. So the operating margin here is 3.5%. The net profit margin is 2.3%. So this business is not about high margins. It's not exciting. It's not sexy. It's very, very down to earth. 2.3% net margin. It's built on quantity. It's built on longevity. It's built on discipline. And it's not built on explosive results. But it's going to keep grinding every single year for you. And I think it's one of the best stocks as far as a dividend stock to add to your portfolio right now. But again, just my opinion, might be inaccurate, might be completely wrong, might be the remedies of madman. That's not financial advice, doing research and all that good stuff. So let me show you a little bit about this company. Now, for the past 3 quarters, Bungie Limited has beat its earnings, which is something that in this economy shows you a lot. When the economy was in the toilet, the stock market was in the toilet, everybody's earnings were, toilet. For the past 3 quarters, Q3 2022, Q4, and then Q1 this year, they've beat earnings. And that's telling you a lot about this company. Now, let's look at the numbers first, but also there's one more question you should ask me. Well, Tom, why are we talking about this company now? What happened? Well, something big happened this week with this company, and I want to show you why this big event, which somehow isn't priced into the stock price yet, makes this company even more undervalued. And I'll show you that in a second. So let's look at this company right here. So revenues are 66.7 billion a year. Revenue growth is 7% last year. Over the past 5 years, they grew revenues by 47%. Very, very nice. Now, net income is 1.6 billion. Very nice net income. That's the sort of business I'm talking about. This is business 101. 1.5 billion, low margin, but so much money. That's what we love to see as investors, money. At the end of the day, that's what matters. Now, its balance sheet is very, very clean. We have total assets of 27 billion, total liabilities of 16 billion. The ratio of assets to liabilities is very good. Now, it is a little bit over leveraged with 3 billion of cash, with 6 billion of debt. But for an agricultural production company like this one, a high debt structure is kind of par for the course. That's normal. It's a high cash demanding business. That's okay. Now, what I do want to show you here, what excites me the most, is that we're talking about a dividend company with 2.6% dividend, which has been bitten down over the past year, down 10%. It's growing at 7% a year, 50% of the past 5 years. So it's giving you 5 to 10% growth a year. It's net income positive, and it's trading at a multiple of 9. Price to earnings of 9, price to sales of 0.2. We're talking about a company that's trading at 0.2 price to sales. It is an extremely low multiple. 9 PE is, again, this is not an expensive company. With everything we've just seen, you're getting this at a very cheap price. The idea here is you want to find a deal. When you find a new car you want to buy, when you're buying a new house, you want to get a good deal on it. It's not, it's not complicated to buy something great and overpay. All the rich people, they do it. It's normal, right? But the idea is you don't want to overpay. And I think this company, price to book 1.3, price to sales 0.2, price to earnings 9. The price here is extremely attractive. Now, the next thing I want you to look at is the institutional shareholding. This company has 88% institutional shareholding. It means it's extremely stable. It doesn't have a high retail percentage, which means it's not going to be as volatile as retail heavy stocks like Palantir, for example. The other thing, and by the way, it's mainly owned by BlackRock and Vanguard. You can see here that the amount of shares that over the course of the past 3 years of institutionals have went up. So this is a chart that shows you the trend of how much institutional shareholding is in this company. It's pretty steady, but over the course of the past 3 years, they went up from 110 million shares to 127 million shares in just 3 years. So institutional shareholding is good. It's going up. It's staying steady. And I think it's going to give this company a lot of stability. The next thing I want you guys to see here is analyst predictions. Again, let's take this with a tablespoon of salt, right? We know what analysts are good for, but most analysts are looking at this at 134 price per share. Low target is 120, high target is 144. The share is currently trading at $94. So at least analysts, for whatever that's worth, are saying that this company is undervalued, but I don't trust analysts. I want to do my own research. So let's go to our DCF model. Okay, so this is my DCF model on Stock MVP. This is a platform which I'll mention at the end of the video, but it makes it really easy to run a DCF model. As you can see right here, it will auto-populate all the data from our own database because we have access to the financials of the company. And you just have to adjust the growth rate. I put it here at 3.5%, half of the current growth rate, depreciation rate, capex rate, and then the discount rate. So I do populate, calculate, and that's all. Now, this is the rate I'm getting, $120.94. This is, in my opinion, the fair market value of this company, $120.94 based on very conservative assumptions. And that's that easy with this DCF modeling tool. Now, I do want to bring up another interesting point. Now, you might say, well, Tom, if this is a $120 stock, why are we even talking about this anymore? Because it seems pretty good, but it gets better. Now, what happened here is that over the past few days, we found out that this company is actually merging with another company of equal size and with absolutely complementary business model. And I think it's absolutely brilliant, especially since it was not priced at all in the share price. So I'm going to go back to stock MVP view right here for Bungie Limited, right? So you see the numbers here. So based on these numbers right now, right, it's super easy to see that this is a great company. Now, let's add to these numbers what I'm about to tell you right now. So a few days ago, there was a merger that was announced between Bungie Limited and Viterra. Now, Viterra is an $18 billion business, very similar to Bungie. Now, Bungie is buying it for $2 billion of cash, $6 billion in stock. Essentially, the shareholders of Viterra will get shares of Bungie, and they're going to be taking on $10 billion of debt, essentially buying their debt. And it's an equal-sized company. Viterra is an absolute phenomenal business. They have 270 storage facilities, 30 port terminals, 15 crush plants around the world. So they have a lot of logistics, and that's the key point I want to explain here. So while Bungie Limited mainly makes its money by processing sugar, soybeans, wheat, and all that good stuff. Viterra is actually a logistics company. Their business is 65% from handling and merchandising, which is exactly the things that Bungie Limited is not excelling at. And them merging creates the perfect mix. In fact, they're going to be more balanced as one unit, and they're going to complete each other. And somehow, this is completely not reflected in the share price. So in my opinion, my humble opinion, this is a $120 stock. And currently it's trading at $94. I think for me, it's a buy. But again, you have to do research. This is not financial advice. I might be wrong. I might be inaccurate. This might be the ramblings of a madman. This is not financial advice. Do your research. In my own personal opinion, this is a $120 stock that you can buy at $94, get a 2.8% dividend yield. You have growth here, you have a cheap price, and you have a catalyst, which is not yet priced somehow in the share price, which is absolutely phenomenal. Now, before I let you guys go, a few items here for the OGs. Now, if you just came here for the analysis is finished. Now, if you want to stay and listen how you can actually benefit and learn a new system, stay with me for the next minute. I'd really appreciate it. Now, I understand most of you will leave, and that's okay. This is not for everybody. So the first thing I want to explain here is that what I've used here is this platform called Stock MVP. Now, Stock MVP is my own platform. I've built it along with my business partner to complete something that we don't have as retail investors, which is modeling tools, financials. You can see right here, if I scroll down, I have access to full financials of the company, all the data, all the cards and everything. So I've built this tool to complete something that I couldn't find online. We are now, unfortunately, having to raise the price of this. And this is, I know it sounds silly and cringy, but wait. We launched an app on the App Store. Now, the App Store does not allow us to use any discount codes, any coupon codes. It doesn't work like that in the App Store. And we can't offer that on our website if we're not offering that on the App Store. It's pretty much, Apple policy, et cetera, et cetera. So within the next few days, the coupon code that is currently on the screen, last50, is going to go dead because we have to kill it because of terms of service. So if you want to get Stock MVP, go to stock-mvp.com, use the code last50. You're going to get it at 50% off for your lifetime of use, and then you got it at half price. Within a few days, that's gone, and that's not a joke. And then we have to go full price because of terms of service on Apple. So, if you want to get it, if you're on the fence, try it out now. Get it, use it for a month. You don't like it, you cancel it. At least get the discount. The other thing I want to talk about here today is real quick is, look, I want to show you something. And I waited till the end of the video to share this with you because this made my day. Look, this is a message I got on Patreon today, this morning, and I was blown away. Hey Tom, just wanted to say that I've been part of few finance community, and yours is the best I've been in. I've learned so much from your recorded Zooms, your engagement with the community, and other content. I've connected with Greg. Greg is my community manager and a genius of technical trading. He has his own channel called Investory to set up some technical analysis training, and I wouldn't be the same knowledge position without this channel. Thanks, mate. I said that means a lot. You made my day, but in all honesty, it made my month. I truly appreciate hearing things like this. It makes my heart full. It makes my motivation stronger, and that's literally why I do this. Obviously, it's a business, but things like this, they motivate me a lot more than you know. Thank you for this message. I'm not gonna, give away the name of the Patreon that sent this to me, but this really made my day. If you want to join, I'm going to put it on the screen right now. If you want to join and test it out, I've just added on the screen, patreon.com/Tom Nash. It's $5 per month. And it's intentionally low, $5 per month intentionally. So it's the price of a cup of coffee. So everybody can afford it. I want to democratize information. I want to keep it simple and cheap and over deliver so that everybody enjoys it. So the price will never go up. It will always be $5. Never it will go up. Obviously, there's more expensive tiers, but what you'll be getting is the opportunity to join this community. As you can see right here, this is a Discord. It's insanely active. And on top of that, we have things going on our Patreon page, which is where I post my share analysis. For example, this is a share analysis I just shared about undervalued stock with big long-term potential. And you can see the analysis right here, but there's also posts that I do here and exclusive videos, which I post of myself talking about things that I don't post on my main channel, etc., etc. So if you want to join, it's patreon.com/Tom Nash. Thank you for allowing me to kind of explain what I'm doing beyond just the free videos here. And if you stay this long, comment below. Let me know you stayed till the end of the video. I'd really appreciate it. Thank you so much. I'll see you in the next video.